Are you just starting out in trading and wondering exactly what fundamental analysis is? Are you subscribed to an economic calendar that notifies you about important news events? And do you ever wonder what those news events mean and how you can interpret it? Well, if you said yes to any one of these questions, then go ahead and hit the subscribe button as well as the notification bell. And that way we can stay in contact with you and continue adding value as we journey alongside you on your way to success. Hi, my name is Dean Miller from Wealth Tip, where our tip for wealth is to trade, invest, and prosper. And I would like to welcome you all to the first launch of our exciting new YouTube series, The Art of Fundamental Analysis. In today's episode, we're going to be talking about inflation, which is one of the largest economic indicators to affect the global economy, specifically the currency markets. Now, if you actively trade the financial markets, regardless of the asset classes that you participate in, you may have been hearing a lot of talk around the subject of inflation from economists to political leaders and various types of analysts. And to be perfectly honest, it's not looking good, particularly for the UK. Early in May, the governor of the Bank of England, Andrew Bailey, said that a surge in food prices could have, and I quote, apocalyptic consequences for the poorest people in society and the global economy. So with this comes no surprise, as this is the effects of inflation. However, it's very important to first have a rudimentary understanding of inflation before we can interpret its effects on future markets. And we'll do this by addressing the elephant in the room, which is, what exactly is inflation? You see, in one simple sentence, inflation is the decline of a currency's purchasing power. In other words, what you pay for a loaf of bread today is far more than what you paid for a loaf of bread a year ago. You see, this is because the value of a single unit of currency has gotten weaker with time. The result of a weaker currency means that you need more of it to make a purchase. So, as the currency loses value, prices begins to rise and it buys fewer goods and services, ultimately impacting the general cost of living for the common public, which leads to a decline in economic growth. In summary, inflation weakens the purchasing power of every unit of currency with time. So the longer you hold on to a dollar, the less you can buy with it. So how do we beat it? The answer is really very simple. You need to have a large asset base that's valued in currency. So things like real estate, company shares, businesses, etc. So the weaker the currency becomes, the more your assets are worth. Now, bear in mind, I said the answer was simple. I didn't say it was easy. But here on Wealth Tip, we're all about trading, and trading does offer an alternative. But make no mistake about it, this is not a shortcut. It is simply just an alternative. So let's go ahead and see how you can beat inflation through trading. Now, on the 30th of May, the Washington Post released an article that was updated June of this year. Now, if you want to go ahead and read this article, the link of it will be in the description box below. But for now, I'll go through the part of the article that is most relevant to this video. Now, the Federal Reserve raised interest rates for the first time in 4 years by 0.5%. This was the sharpest rate hike in more than 20 years, according to the article. So this rate hike did allow for a slight inflation decrease, as reports show that as of April this year, inflation eased to 8.3% compared to a year earlier, where it was 8.5%. However, inflation remains at a 40-year high, with still a long way to go before the US economy is stable. Now, all this is good and well, but what does it actually mean for us as traders, and how can we capitalize on it? Well, what we'll do is we'll jump on the charts and have a look at the S&P 500. Now, you can see here that inflation had a really negative impact on the top Fortune 500 companies of the US, seeing a significant drop in the index since Jan of this year. What this means is that the US economy is slowing down significantly. But if we were to jump over to the DXY, which is the dollar index that tracks the dollar's performance against several major currency pairs, we can see that since Jan, the dollar has been on a bull run of note, revisiting highs that were last seen in 2017. So what this tells us is that there is a large amount of US dollars in circulation, and this is ultimately the effects of inflation. You see, as the value of the dollar becomes weaker, people are more likely to spend their money while it still has an ounce of purchasing power. Now, to combat this, Reserve Banks increases the interest rates in an attempt to reduce spending and borrowing to purchase high-risk assets such as real estate, just until the economy begins to stabilize. So, what are the 5 things that we can do as traders to beat the effects of inflation? So, the first thing is to stay up to date with the global economic events. You can do this by subscribing to platforms such as investing.com, where you can get updated economic articles, and also subscribe to the economic calendar, which tells you what news events are being released and when. The second thing that you can do is you can trade the aftermath of these events. You see, many traders, especially newcomers, tend to trade the actual event itself. And in my opinion, and in the experience of many other traders, this is a sure way to lose money in the long run. You see, trading the events can be extremely risky considering the amount of market volatility and the spread charges from the broker. You could lose a lot of money even if you call the right trade, just due to spread alone. So the best thing to do is to wait for the results to come out and then trade the aftermath thereof. The third thing we can do is to aim for an annual return above inflation. Now, many people ask me how much they can make from trading, and my answer remains the same all the time. You can make as much as you want, granted you have the discipline to hold on to your profits. But if you'd like to set yourself a target, then be sure to set a target that is 3 times above inflation. What this will do is that if you hit your annual target, then your account will be growing above inflation, which means that you'll be able to maintain growth over time that will always be ahead of inflation. The fourth thing that you can do is to have a long-term outlook. If there's one thing that I can confirm, it's that there will always be inflation. So make sure that you're always working towards building your trading account to perform well above inflation on an annual basis. So for at least for 5 years. From here, you'll be able to do partial withdrawals quarterly, biannually, or annually. And this will ultimately not necessarily affect the overall growth of your account. And then fifth and final thing that you can do is to treat your trading account like an investment account and not a savings account. If you forget anything that I said throughout this video, then go ahead and watch it again. But don't forget this. When you trade, let go of the notion that you can do monthly withdrawals. This is a detrimental and short-sighted mentality made popular by people that doesn't know how to grow an account. Remember, trading is a marathon, it's not a sprint, and the traders that beats inflation year in and year out does so because of these 5 things. So guys, I really do hope that you enjoyed today's video and that you were able to extract some value from it. If you have any questions or would like to add to the discussion, please go ahead and do so in the comment section below, and I'll do my best to respond. Furthermore, I do hope that you all have an amazing weekend and a profitable week ahead. But up until then, keep well and bye for now.